Thank you all for joining us. We are just going to wait 1 minute while everybody enters the webinar. Well, thank you for joining the first ever virtual Eggs in the Economy. We wish that we could be in person with you all enjoying eggs, but as one of my colleagues joked, it's good to see that people don't just come for the eggs and that you're all joining us. So thanks for being with us today. You know, Eggs in the Economy is a quarterly gathering that CSPR puts on to bring different policymakers, budget analysts, economists together to hopefully educate all of us a little bit more on the state of things in Colorado. We were talking, and March 9th was our last Eggs in the Economy, and I'm sure that week is kind of embedded in everybody's memory. Legislative session was in full swing. On March 11th, just a few days later, the NBA canceled their season, and then it seemed kind of like all the craziness unleashed. So it's pretty interesting. I think that we might have had one of the very last in-person events in Denver on that day. We heard from Lauren Larson, who gave us kind of a snapshot on where the potential COVID crisis could end up. And I don't think even in her wildest dreams, she would have forecasted the state having a $3.3 billion shortfall in the budget. A little bit about Common Sense Policy Roundtable. We are a nonpartisan research organization. Our staff and team of fellows are at the forefront of all of the major policy initiatives and discussions facing the state. We look to examine the fiscal impacts of all of these said bills or initiatives for Coloradans and policymakers so they can hopefully make the most informed and well-educated decision moving forward for Colorado's economy and jobs. Just a quick agenda on what we'll cover today. We're going to be hearing from Kate Watkins, who is with the Ledge Council. Well, Patty Silverstein will be joining us. CSPR fellow Simon Lomax will be going over some oil and gas economic outlook. And then we'll also hear from Senator Bob Rankin, who is a member of the Joint Budget Committee. We'll be taking questions after every single speaker. So if you do have a question throughout the program, please use the chat function at the bottom of the screen or raise your hand, and we'll make sure to get those questions answered. One other thing, we have a very exciting announcement at the end of our program that Common Sense Policy Roundtable would like to share with you all, so please stay on until the end, as you won't want to miss this news. So it's my pleasure to first introduce Kate Watkins. Kate leads a team of economists who provide forecasts and fiscal policy analysis on potential bills. She previously was the regional economist for the Federal Reserve, and she also had a job with Booz Allen for quite some time. Needless to say, we call on Kate and her team quite often, and we're thrilled that she's joining us today. She is the chief economist for the Colorado State Legislature's nonpartisan research agency, Legislative Council. Thank you, Kate, for joining us, and I will turn it over to you now.
Thanks so much, Kristen, and pleasure to be here today with all of you remotely. All right, so the slides that you'll be seeing today in this presentation is largely what we presented to the Joint Budget Committee on May 12th. And so as Kristen was mentioning before, in March, we have our typical quarterly forecast presentation, and we went forward with that on March 16th. Coincidentally, that was the same day that kind of kicked off some of the really kind of more strict restrictions that went into place. Very shortly thereafter, it was stay-at-home orders and everything else. So much has radically changed relative to March. So much so that we did a special and very unique forecast update. That is something that our office has never done before. So what you're seeing today are slides from that update. It was May 12th to the Joint Budget Committee. The Office of State Planning and Budgeting, where Lauren Larson is the director, also presented a forecast that day, and I can talk a little bit about the comparison between the two throughout these slides. So relative to May, and Chris, if you could advance to the next one, or relative to March, here you can see kind of a comparison of what has transpired over the last basically 3 forecast updates that we've provided. So in December, we were expecting a leveling off of economic activity consistent with a mature economic expansion. We were already seeing slower rates of growth. In March, we were starting to see the early signs of COVID-19, but not a stay-at-home order. The day we presented was when restaurants and bars were closed. And even that seemed unimaginable. So certainly a lot has transpired in actual conditions. What we've seen is the economy fall off a cliff, frankly, relative to our March expectations of just a kind of minor contraction in economic activity. So certainly, I don't know that any one of us could have imagined what has transpired. So where do we go from here? This is sort of the big question, and the shape of recovery is something that we'll be watching and economists will be debating for quite some time. So what you're seeing here in blue is our current projected growth as of this May forecast update. And the notable things here are just the magnitude of the decline. So that this is the part that we know the most about. The shape of recovery coming out of it is the least we know about. But in terms of how far we dropped, we think in 2020, we're going to drop about 5.6% in terms of GDP. So that's your inflation adjusted aggregate economic indicator of US economic activity. Looking at that projected growth rate relative to what we saw during the Great Recession, you'll see that it's twice as big in terms of peak to trough growth on an annual basis. So really sizable contraction in economic activity. What's baked into that is a pretty extreme pullback in consumer activity, in particular consumer consumption of services, though a lot of durable goods also saw a radical decline during the shutdown period. The vast majority of that contraction is concentrated in the second quarter of the calendar year. What you also saw during that time period, or what we also experienced, has been a large pullback in business investment, business activity, as businesses have been largely shuttered across industries in many cases. And this isn't just a local phenomenon, it's something that's been happening worldwide. So that's impacted exports as well. What's offset some of the decline has been the unprecedented stimulus that we've seen, the monetary policy and fiscal policy stimulus that has helped stabilize markets. So that's cushioned the fall to some degree, but we're still seeing really sizable contractions in economic activity. So the big question mark is, how do we come out of this? And a lot of that is wrapped up in our assumptions for the trajectory of COVID-19. You could turn to the next slide. What we assumed in our May forecast update is a gradual reopening of businesses throughout 2020. So nothing, not a we all open the doors, everything resumes to normalcy, nothing like that expected for quite some time, but just a gradual kind of phased in reopening. We're expecting some limited resurgences of the virus, but no additional widespread outbreaks, no additional stay-at-home orders, and that's important in that if we do have those things, then certainly we would see more like a double dip recession, or certainly it would take much longer to get out of this hole that we're in. Finally, we're expecting a COVID treatment to be available within 12 to 18 months. If that happens sooner, then we would expect economic activity to resume at a faster clip sooner. But if it happens later, then we'd expect a more protracted recovery. So that shape of recovery could be a double dip, certainly could be slower than what we're currently projecting. In terms of just an overarching economic outlook, and you'll notice that when it comes to the economy, you're not seeing a whole lot of slides about economic activity, and that's because we just don't have the data yet. So in terms of the outlook, kind of looking forward, we know how far we fell, but again, that question mark exists when it comes to, what's the trajectory from here. So in our May update that informs our revenue projections, economic activity, of course, we know that it came to a standstill. We are expecting to grow from those low levels, gradually throughout the rest of this calendar year and into 2021, but not really resuming pre-COVID levels of economic activity until at least late 2021 or 2022, if not later. Business activity and consumer spending, we expect to rise with the phased reopening, but remain constrained throughout this time period for the foreseeable future. And that's not only on restrictions, but on health concerns. So even with reopening, a lot of consumers will not want to go out for fear of contracting the virus. Overarching uncertainty will weigh on business investments. And then finally, some businesses we expect not to reopen. And certainly that leaves a hole in the economy. Labor markets are expected to improve at a slower pace than business and consumer activity. This is consistent with prior historical recessions, certainly. So we're expecting pretty weak labor markets in both 2020 and 2021 as businesses adjust to this new and evolving landscape that we find ourselves in. And finally, inflationary pressures we do expect to remain relatively subdued for the near term in spite of unprecedented monetary policy. And that's largely on super low energy prices and also low global demand for US goods and services. So turning to the next slide and more of an outlook for the state budget situation. What we tend to do here is focus on general fund revenue collections. The state has three different main sources of funding. One is the general fund. Those are your kind of more flexible dollars that are coming in. One is federal funds and one is cash funds. Cash funds are varied. It's everything from vehicle registration fees to tuition revenue. But they're not so flexible in that they're generally speaking required to go to certain types of programs. General fund dollars are the dollars that are more flexible. They're what the General Assembly decides to spend upon. So that's where a lot of the emphasis of this presentation is. Here you can see our projections for general fund, gross general fund revenue, and we're currently projecting sizable declines consistent with what just transpired with the economy in a digging out of this hole at a somewhat quick pace, but digging out of a hole nonetheless. So fairly dramatic declines in revenue collections, 7.2% in FY 1920, 11.6% in 2021. Peak to trough, that's an 18% decline. Relative to prior downturns in both the 2000 and Great Recession, we saw declines peak to trough of about 17%. So a little bit worse peak to trough than what we were seeing over the past two downturns. Relative to March, really large reductions in our expectations in terms of the magnitude of dollars. So turning to the next slide, you can see the sources of general fund collections, and the vast majority is coming from individual income taxes. Sales and use tax certainly makes up a decent amount at 27% as well, but the lion's share is coming from individual income tax. And with that, it's most of the volatility in this particular general fund source of revenue is in business incomes. And that's why you see that outpaced decline in general fund activity relative to economic activity. And this is where our budget pressures come into play. So the volatility is attributable to, in part, the structure of the revenue streams coming into the state, in part the tax structure that we see where if a business takes a loss, they're not going to be paying income taxes. And that's the main source of the volatility. So next slide. I did want to mention the Tabor outlook, and that I know that it's something that certainly is on people's radars. Basically, we went from being in a Tabor surplus situation to being very much below the referendum C cap. So no Tabor refunds expected for the foreseeable future. It's going to take quite a bit of time for us to get back up to that referendum C cap. And so again, turning to kind of the budget big picture, when we talk about general fund revenue, what does that mean in terms of total state funding? So here you're seeing the current fiscal year's operating budget, and these amounts, this $32.5 billion, that it is subject to change with basically the sequestration and the other cuts that are going on right now. But this certainly gives you a pretty good feel for where those three sources of revenue are coming from: the general fund, cash fund, federal funds, and where they're going. The biggest being healthcare, largely Medicaid payments. Second is K-12 education, followed by human services, higher education, and corrections. Those are kind of your biggest state expenditures. Next slide, zooming in on the general fund specific portion of the budget. And again, this is where we focus our attention, and that these are your flexible dollars, so to speak. So the largest single department receiving funds from the general fund is K-12 education. It's a little more than a third. Healthcare follows that up a little more than a quarter, followed by higher education and human services and corrections, and then all other departments thereafter. So when we're talking about, these $2 billion reductions in general fund revenue as a result of this COVID-related contraction, that's a lot of money, and that's affecting these particular departments that receive the most funding. So next slide. So turning to this, the general fund budget outlook and kind of what this reduced revenue expectations or the contraction in revenue means for the state budget. In the current year, based on our May forecast update, we are expecting an about $96 million deficit. This doesn't account for the $230+ million in sequestration that were a part of the governor's executive order. So basically, if you account for that, it would be a smaller deficit, but a deficit nonetheless. That estimate is based on current law, and so changes in transfers, in spending, accounting for sequestration, and accounting for the reserve requirement, what's required to be left over at the end of the fiscal year. With those changes, you could eliminate this deficit for the current fiscal year. Next year, the General Assembly has not yet set a budget, but is in the process of doing so. And Senator Rankin can certainly speak to this, kind of some of the steps that they're taking in order to balance the budget or to set a budget that's at a much more reduced level than the current year's spending. But based on our May forecast update, we're expecting a $3.3 billion shortfall in revenue. And I want to unpack that number a little bit because it's ended up in the headlines, and so I think it deserves a little more attention in that there's a lot baked into that $3.3 billion shortfall number. What that amounts to, though, is a 25% cut in spending relative to the current year. That is sizable when you're kind of going back to the last slide and looking at what the departments that are affected and the magnitude of that amount. We're talking about a lot of money. So what's baked into this $3.3 billion is first that prior year deficit. So any changes made in the current year would affect that amount. So if you account for the sequestration, then that $3.3 billion shortfall turns into about a $3.1 billion shortfall. So any changes made to the current year will affect that next year budget. This amount holds appropriations constant. So it's not accounting for any inflation or caseload pressure. If you account for those types of things, it would be a larger shortfall. So we're holding spending flat, factoring in that reduction in revenue, and that's where we land at this $3.3 billion shortfall. So changes can be made to a number of different things, current year spending, current year requirements, and next year's requirements for transfers. All of those could impact this shortfall and could result in a smaller shortfall without having to cut spending. That said, it's a large enough shortfall that spending reductions we know are certain at this point. And next slide. So to round out this discussion, I think one of the biggest takeaways is elevated uncertainty right now. There's so many unknowns, not only with COVID-19, but with some of the policy responses to it. So fiscal and monetary policy stimulus in particular, we expect to, that we don't necessarily know that there's going to be additional rounds of fiscal stimulus and stimulus to states, but that could be something that offsets some of these significant revenue reductions or revenue declines. The containment and treatment of COVID-19, though, is the biggest risk to the forecast. We don't know if there will be a resurgence. We don't know if there'll be another shutdown order. These types of things certainly cloud the outlook. This is a forecasting situation that certainly none of us have found ourselves in before, where that level of uncertainty is really quite pronounced. So on the downside, we could certainly see a more prolonged economic recession or double dip recession. On the upside, however, we could see a stronger near-term rebound, especially if we were able to find treatments and or test and confine the virus in the near term. So that largely concludes what I wanted to mention today in just sort of rehashing what we presented to the Joint Budget Committee on May 12th. you'd like to take a look at our forecast projections or dig in a little bit deeper, there's a link at the top of the slide to our economic forecast. We're in the process of doing a June forecast, our regularly scheduled June forecast, so certainly keep an eye out for that. Also included a couple links to other resources that might be of interest to all of you. So again, thanks for your time, and I think we're doing questions now. Otherwise, happy to answer questions at the end.
Thank you so much, Kate. Really appreciate it. Extremely insightful. Appreciate all your team's hard work these last few months too, as things have changed rapidly. We do have a few questions from participants. First question is regarding the COVID-19 related forecast assumptions. Why not include the assumption that the pandemic might follow the same path that the 1918 flu did with a second major spike?
That is a great question, and it is something that is a very much a real possibility. We could model a number of different assumptions. What we chose to go with was kind of this gradual reopening, not a profound spike in or double dip in recession as a result. But you highlight one of the primary risks to our forecast. The reason we didn't go there is that we have to pick some assumptions, and what we felt like at the time when we were working on the May forecast update was that the most likely assumption is that we would have this gradual phased reopening, and that we would have limited resurgences that are kind of more local and less of a more global outbreak, so that resurgence consistent with the flu at the time didn't seem to be like the most likely scenario when we were working on the May forecast update. That said, as things transpire, we do present a quarterly forecast. We may update our assumptions to the extent that that's looking like a more likely scenario.
Thank you. Another question, this from Lone Tree Councilwoman Wynne Shaw. In general fund state revenue sources, is a sub-S corporation counted as corporate or individual income tax?
Thank you, Councilman. I believe it is on the individual income tax side. Basically, corporate income tax is all just C corps. So I think maybe that gets to your question.
And one other question she has. She understands that Tabor reserves are mainly limited to repairing infrastructure damaged in a disaster. It doesn't cover much in an economic crisis like this. How could those limitations be changed?
So the Tabor reserve, and I think you're referring to the Tabor Emergency Reserve, which the state is required to set aside each year a certain amount of a reserve that's called out in the long bill, and it's basically, well, a lot of that reserve is illiquid assets, so they're buildings in some cases, and so that Tabor Emergency Reserve could be used in order to fund an emergency situation. So in this case, the General Assembly could choose to draw upon that reserve, the liquid and illiquid assets, in order to fund the shortfall. So that's certainly something that is an option. To get there, it would require, essentially, if they maintain the same reserve, it would require selling buildings in order to get there. After drawing down that reserve, the General Assembly also has the ability to issue, basically create emergency taxes that help fund an emergency situation, and certainly the context of a pandemic fits that emergency type of a fiscal emergency, or not a fiscal emergency, but a Tabor-related emergency. So those are certain options that are available to the General Assembly currently, and I'm not sure if that gets to, if that answers your question or not, but there are a number of different options available to the General Assembly should they pursue that route.
And we'll continue to watch this week as the General Assembly reconvenes, and we'll see what happens with a lot of these different options. One last question, Kate. It looks like you are predicting a V-shaped recovery. Is that correct?
Great question. While it looks like a V, it wouldn't feel like a V. I'll put it that way. And part of that is the just the sheer magnitude of the decline in economic activity. So we're seeing it a little bit more, and when we're talking about this particular forecast update, we're pursuing more of a square root shaped recovery. Though when you plot it, it looks more like a V. If you plotted the percent change, it would look a little bit more like a square root shape. So this conversation, ultimately, I think that this particular situation sort of defies the typical vernacular when it comes to recoveries, and that a V, because we're coming out of a hole, it wouldn't really be a V no matter what, and that typically that V is like a bounce back to where we were before. Certainly it's going to take years for us to get back to where we were before. So it does look like a V, but I would caution that interpretation.
Thank you again for joining us, Kate. Really appreciate you taking time out of your busy schedule, and I know you're dealing with a lot of different incoming right now. So thank you so much for joining us.
Thank you.
Our next guest that I would like to introduce, many of you know, her name Patty Silverstein. She's the consulting chief economist for the Colorado Association of Mechanical and Plumbing Contractors. One of our board members, Dave Davia, serves as the head of the Colorado Association of Mechanical and Plumbing Contractors as well. Patty has had a long career in Colorado, specializing in economic research and real estate analysis. She also serves as the consulting chief economist for the Metro Denver Economic Development Corp and the Denver Metro Chamber of Commerce. Whether you know it or not, I'm sure that you have read reports conducted by Patty and her amazing team. Thank you so much for being with us today, Patty, and I'll turn it over to you.
Wonderful. Thank you so much, Kristen. Good morning, everyone. I am delighted to be here with you to share our study on the construction outlook. And thank you to Dave Davia and the Colorado Association of Mechanical and Plumbing Contractors for sponsoring this project. If we can move on to the next slide, Chris. So this study is intended to look at what construction activity we will expect over the next 5 years. And just a quick word to say that we delivered this report at the end of March. So it was kind of that whole middle of March type of time frame that we were certainly scratching our heads saying, how does this influence our long-term outlook for construction activity? And while certainly we see some changes in the short term related to construction activity, our expectation is still that for the longer term, again, going out to 2024, that activity should, we'll see kind of a limiting of activity in the short term, but picking that up again in the long term. So our expectation is that our final numbers here are still relevant, that the trends that are revealed are still relevant for this. So we look at the entire state then and break it out into 6 different areas. Those geographic areas are basically distributed according to the metropolitan statistical areas in our state, but then also we have this whole balance of state, which is everything else, which is obviously a lot of territory here in Colorado. Next, please. We organize this forecast by different property types. We look at multifamily, office, industrial, retail, healthcare, education, and then we also try to provide some insights as far as government and public projects. Each segment of the report looks at kind of the national overview, what we see here in Colorado, and then the supply and demand drivers for that particular property type. And then we present our construction forecast. So I want to walk you through our summary results for this today. So moving on, the first parts of our forecast, or the first parts of our properties that we include, are those that are influenced by an employment forecast. So office, industrial, and healthcare are the property types that we see most influenced by our expectation regarding employment. And for our employment forecasts, we are working with the Colorado Department of Labor and Employment, their long-term forecasts. So jumping into our first property type then, we'll look at office influences. Here, the office market throughout the state of Colorado is definitely influenced by tech companies. They have been some of the key drivers of the office space that we have been using. Our companies are moving closer to their available labor pools. A big part of this whole forecasting process is to try to figure out how much office space do we need per employee. And certainly that we expect that that will be changing somewhat with the whole COVID situation, but right now we're looking at an average of about 230 square feet of office space per employee. But certainly the whole telework, telecommuting, the remote work, co-working also influences those types of space needs. And the other thing that is influencing this right now too is the oil and gas fallout, and that concern, especially for the downtown Denver market. Next slide, please. Going through, I want to, using the office property type as an example, I want to walk you through a bit of our forecasting process. So we start again with those employment growth trends, and we look at the employment growth all throughout the state of Colorado, divvy it out by those sub-regions then of the state, and we're looking at then for the office forecast, we look at those office using employment subsectors. So things like information, finance, and insurance, a lot of our professional, scientific, technical services, versus our other property types are going to be focused on those types of workers that most likely go into an healthcare situation or an industrial situation. Next slide, please. As we saw then, we have slower employment growth that is expected in our office market, but we also need to take a look at how much square footage we have in each of these markets and whether we're in any type of oversupply or undersupply situation right now based upon the current vacancy rates. So we look at trying to drive these to what we call a stable vacancy rate, those stable vacancy rates being higher generally in our larger areas like Metro Denver or Colorado Springs, because you have more business churn, more activity happening there, so you can operate with a higher vacancy rate versus some of our smaller areas where we tend to see a lower vacancy rate then. About 31% of our employees are in office space. Then moving on, we bring in then, moving to the next slide, please. We bring in then that whole demand side, what we see happening in terms of employment. We look at supply, whether we're in oversupply, undersupply, what's under construction, to come to our final results as far as what additional space will be needed to accommodate all of these workers in the next 5 years. And we compare that to the prior 5 years, just so that organizations and companies can figure out, you know, is this going to look like where we have been, or will we see some type of slowdown in activity? What does that mean for our staffing needs? What type of staffing patterns are we going to need to accommodate that? And then the last way of showing the results of this, if we move to the next slide, please, is to just highlight it from, you know, a pie chart to show where is this activity happening and how is this going to be changing from that prior 5-year period to the next 5-year period. And here we see that as we look at the amount of office space that will be needed throughout the state of Colorado over that next 5 years, we have about a 4% decline in the square footage needed, but definitely a different distribution of space that will be needed. Now with more office space being, or a greater percentage of the office space going into the Colorado Springs area, again, that cheaper alternative to Metro Denver versus the balance of state. So that's kind of the highlight of how we approach all of this. Let me just walk through quickly these other market types, our other property types, talk about the influences and kind of the bottom line of what we're seeing within that. So on the industrial side, not surprisingly, the big driver of the space is what's going on the distribution side, the e-commerce. The Amazon influence is huge throughout the state of Colorado right now. In order to accommodate the Amazon influence, we are seeing that some of those older warehouses and industrial spaces are being converted into other uses. So we're seeing rising up, if you will, of new higher ceiling spaces that can accommodate the types of logistics needs today. Trade sensitive regions throughout the country, those that are influenced by international trade, there are some concerns, potential weaknesses, not as much of an issue here in Colorado, but still nonetheless an influence. So the next slide then looks at then how we will see the distribution of industrial space throughout the state of Colorado. Notice we are expecting about a 34% decline in the amount of additional space that will be needed over the next 5 years. The big changes in this marketplace being more like in the Colorado Springs area, where we're in the northern Colorado area, where we're seeing that these distribution facilities are trying to get closer and closer to their concentrations of population. So rising up then the need for new industrial space within those particular areas. Turning now to the healthcare influence on our next slide, we see slower expected employment growth in this segment as well. We're starting to see some shifts and changes as far as how healthcare is being delivered. So we are seeing kind of a push for more of an off-campus urgent care type of facility. You know, for a while we saw many of the healthcare facilities being more on campus. Now we're seeing that more distributed out into the local communities. And what that results in then, if we go to the next slide, is that we are looking at about a 12% decline in the amount of new healthcare space that will be added, with the needs increasing again according to some of those employment growth trends, as well as some of the population growth trends, pushing some increases into the northern Colorado and into the other balance of state. Moving on to our property types then that are influenced by a population forecast. So rather as our population increases or changes, then we're seeing changes in the amount of retail, education, multifamily space that is needed. So moving on to the next slide there looks at our population growth by region, and we see that in general, our state demography office projects that we will see slower population growth over the next 5 years compared to where we had been in the previous 5 years, and pretty much slowing in all locations with a little bit of a bump up in the balance of state. So how does that play out then in terms of our retail activity? And in the next slide, we can take a look at some of these broad influences on retail being a population growth, but we've seen this market more than perhaps some of the others rapidly changing by the pandemic. Of course, the pandemic has reversed some of that retail momentum, clouded the outlook for this sector, especially in those retail, whether they be shopping malls or strip centers or whatever that have integrated entertainment and dining. Those areas certainly very much influenced by the pandemic. The result of all of this then, as we go to the next slide, is that we do expect the most dramatic decrease in the need for retail space of all of our property types that we are looking at, about a 38% decrease in space, and really a slower amount of needs, similar distribution, but slower amount of needs in all areas of the state. Moving to the pre-K through 12 education, then we break up our education system into the pre-K through 12 as well as the higher ed. We are seeing some slower growth in the pupil membership there. And what had been driving some of the availability to construct new facilities for education was that we had these rising property values, local bond elections, we had the marijuana excise tax that was flowing, that was really funding some of this additional construction activity. Certainly some of the property value issues right now, we're not sure how that is going to be changing in the future, and whether that funding will be quite as solid for any type of our educational facility, those capital needs. The bottom line on that then, when we take a look at the whole pie distribution there, is that we do expect about a 16% decline in new educational facilities being constructed. Really the needs in Grand Junction, kind of balance of state, were the only areas where we saw some perhaps increasing needs, otherwise pretty much stable throughout the rest of the state. And then looking at the post-secondary education market there, This was one that we had been seeing growing demand from non-residents and from international out-of-state students. That's going to be a little debatable for the coming couple of years again. So that short-term outlook may be a bit different from a longer-term type of outlook there. We were generally seeing increases in pupil trends. Again, some of the universities, of course, right now are kind of scratching their heads, wondering how COVID is going to impact that future enrollment trend here. Bottom line then, when we take a look at the opportunities for new development here, we see that some of the increasing facility needs that had happened in the prior 5 years were up in the northern Colorado region. We see that more shifting into the Metro Denver area over the next 5 years, but again, still a decrease in activity. And finally, taking a look at our last market segment, which is the multifamily. We're seeing slower population growth and aging of the population, smaller household sizes. That all influences the type of housing that is being demanded throughout the state. There's also, of course, that issue of housing affordability. Are we building the types of units that indeed our workers, our residents can afford? We certainly saw a large increase in multifamily construction activity during the whole economic expansion, and a lot of that happening in the Metro Denver region as we were building out our light rail system. But now as we look to the future, over to the next 5 years, then if we can move on to the next slide, please. We are seeing that the number of units that will be demanded over the next 5 years is indeed slower throughout all of the parts of Colorado, with a little bit of exception, a little bit of bump up in the Grand Junction area and in the balance of state area, but certainly seeing the need in the Metro Denver region starting to pull back a bit. Not that construction is ending or the need is ending, but certainly that the activity level is a little bit less than where it had been in the prior 5 years. All of this is then summarized in a nice little matrix here where we take a look at the property type by the geographic region, so you get a nice visual of the expectations of where that construction activity is headed over the next 5 years. So that, again, organizations such as Camp C can really be focused on where are we going to need to be shifting some of our resources, where can our companies be looking in terms of those opportunities, even in light of general decline in the amount of construction activity that is happening throughout the state as a whole, recognizing that there are pockets of opportunity all throughout the state of Colorado. So with that, thank you so much, and I'm happy to answer attempt to answer any questions you might have about this study.
Thank you so much, Patty. I think that's such an interesting perspective and study as we're kind of navigating what's next for the state. A few questions for you. The first kind of drives at the regional component that you discussed previously in the presentation, but what is the possibility that the overall growth might shift to other more rural areas versus a general density on the Front Range?
I think certainly, especially in light of what we have seen happening with the whole COVID pandemic, there's a lot of discussion of, are we going to be seeing more activity in urban core? Are we going to see more of a shift to suburban or rural markets? Are people going to try to distance themselves a bit? And I think that remains to be seen. There's still definitely that whole influence of people that wanting to be within the urban cores, but there's going to be new attitudes about moving out. I think some of the population growth numbers that we are seeing throughout the balance of state area, which includes all of the Eastern Plains as well as all of our mountain communities, that balance of state really being a very broad brush. But the recognition too that with remote work that we can live anywhere in our great state of Colorado. So yes, certainly we are seeing from a population side more of a push or again, a little bit of increase in the growth rate in the balance of state area than what we saw in the prior 5 years.
Thank you. This next question, Kate, you might want to chime in on as well. If there is a major shakeup or collapse in commercial real estate due to teleworking or COVID-related shutdowns, what is the anticipated effect on state and local budgets due to Gallagher? How is that being priced into the forecast?
Let me take just kind of the what we see as far as the demand for the space, and I'll have Kate, if you would, kind of address the Gallagher issue there. But in terms of the demand for space, you know, keep in mind on the office side, we've pondered that quite a bit. But even if a company is now holding their employment steady, they may not want to downsize their office space at all, for example, because they need to have greater distance. Again, keep in mind, we were seeing that about 230 square feet per employee. That may need to be higher now in order to allow for the social distancing and all. So companies may discover that they will accommodate their same number of staff workers by combining both their existing facilities as well as their remote work. Again, the main property type where we see a decline in the need out there is more the retail side right now.
Kate?
Sure. So the Gallagher question is a good one and is definitely going to be putting pressure on state and local government budgets, but not really until fiscal year 21-22. So part of this has to do with the reassessment cycle. And I'll just provide a little bit of background. So the Gallagher Amendment in the Colorado Constitution requires basically a fixed share between residential and non-residential property types. And what keeps that share fixed is the residential assessment rate. So when you have home prices appreciating faster and kind of that residential component appreciating faster than non-residential, then the residential assessment rate ratchets down in order to maintain that fixed share. So right now we're in a situation where we do expect some downward pressure on commercial real estate, but a maybe even more important component would be oil and gas activity, which we expect to, I mean, certainly prices have already tanked, but we expect production activity to fall as well. So both commercial real estate and oil and gas production are in that non-residential component. So with that, we have home prices that are expected to stay fairly steady, if not grow a little bit, and then tanking in oil and gas. Not so great things with commercial real estate. As a result, we're expecting the residential assessment rate to fall. What that means is if it's a local government that has a fairly stable tax base that is reliant on residential, then the residential assessment rate is going to fall, resulting in a potentially dramatic decline of, based on the Division of Property Taxation's latest estimates, could be about an 18% decline in that residential assessment rate from 7.15 to about 5.88%. And that change in that percentage is about an 18% decline. So you could be seeing really sizable reductions in the tax base of local governments. How that translates to the state budget is that the state and local governments, school districts share the cost of K-12 education. So if the local share falls, then the state is required via Amendment 23 to pick up the rest. And so it puts added pressure on the state budget to go towards K-12 education. So not great news across the board, but really not because of the 2-year reassessment cycle. It wouldn't really kick in until fiscal year 21-22 and thereafter.
Thank you, Kate. And thank you so much, Patty. Really appreciated the presentation and insight. We did have a question: would the slide deck and presentation be available after? Yes, it will be posted on our website, www.commonsenspolicyroundtable.org. If you go to under events, we'll have this entire recording and the PowerPoint deck available too. And I know that Patty and Kate, they've left their emails and contact information should people have further questions too. Thanks, Patty.
Thank you.
Our next speaker and next guest, which Patty spoke to a little bit in her presentation, will be discussing energy policy. I think it's been on everybody's minds as we've watched the oil and gas fallout over the last few months and what it will do to Colorado, what it could do to Colorado. And as we look forward to November 2020, there might also be some potential ballot initiatives that might impact this important industry to our economy. I'd like to introduce Simon Lomax, who is the CSPR Energy Fellow. He has spent more than 20 years working in journalism, government, and public affairs. He was a congressional fellow with the American Political Science Association. He also has worked with FTI Consulting, a global business advisory firm, and had several fellowship roles with Vital for Colorado Independence Institute, and now we are lucky to have him with us. Simon, I'll turn it over to you.
Thank you so much, Kristen, and good morning, everyone. I hope you're all staying fit and well, and Kate and Patty are a difficult act to follow, but I'll do my best. You know, I think Kate and Patty's presentations referenced a couple times, and so did Kristen, the you know, what is happening right now in the energy sector and in oil and gas, and there's a lot happening. But my focus this morning is really to examine public policy and how could public policy impact the ability of the oil and gas sector to recover, and not just the oil and gas sector, of course, but the broader Colorado economy. And so with that in mind, I'm here to walk you through a high-level overview of a new report that we published this week called The Economic Impacts of Oil and Gas Setback Ballot Measures, a historical review. And I want to take a moment to thank my co-author on this paper, Chris Brown. You all know him very well. He's the Director of Policy and Research at the Common Sense Policy Roundtable. Now, I'm almost certain that everybody on the webinar today knows about setbacks and about setback ballot measures. But on this slide, I just wanted to quickly recap the concept. You know, setbacks are minimum distances between proposed oil and gas locations and specified areas or locations. And since 2014, environmental groups in Colorado have supported ballot measures that would expand those setback distances to between 2,000 feet and 2,500 feet. And I'm sure all of you are also aware that the setback ballot measures are back again this year in 2020. Now, why are setbacks a big deal? Because if you create a setback that is wide enough and you apply that setback to enough locations, it is possible to block energy development across a very wide area. And that is a major economic concern in Colorado because we are the 5th largest oil producing state and the 6th largest natural gas producing state. And so, you know, common sense dictates that, you know, oil and gas therefore is a major source of jobs, economic growth, and tax revenues for the state government and for local governments and for school districts and a host of other special districts, all of which provide, you know, essential public services that we all depend upon all across the state. Next slide, please. So, oil and gas development, therefore, is, you know, it's a really important part of the free enterprise system in Colorado. And for that reason, since these setback ballot measures were first proposed in 2014, the Common Sense Policy Roundtable has conducted research to quantify the potential impact of these various setback ballot measures. And our new report released this week summarizes this body of research to identify short, medium, and long-term trends across all of the different studies that have been conducted. And it also identifies lessons learned from past research and recent trends in the broader economy and in the oil and gas sector. Those lessons learned for future research that we can use to apply to the 2020 setback ballot measures. Now, in the time we have this morning, I can only really scratch the surface. So I hope you'll visit our website to check out the report in full. But here we have one of the tables from the executive summary of the report. And it really, I think, speaks to the depth and the breadth of the research that CSPR has done on this subject through the years. What this table does is it summarizes the high-level findings of these setback studies that were conducted in 2014, 2015, 2016, and 2018. And if you spend a bit of time with this table, what you'll see is the evolution of setback ballot measures. So they started at around 2,000 feet and were only applied to occupied buildings. But over time, the distance of the setback increased to 2,500 feet. That's just under half a mile. And critically, over time, the application of setbacks was expanded to beyond occupied structures to include so-called areas of special concern. They're also called vulnerable areas, depending on which version of the ballot measure you're looking at. And really what that means is that these setback distances now, as they're currently proposed, would apply in urban, suburban, rural, and uninhabited parts of the state. And that's a critical trend because as I referenced earlier, as the area that is covered by setbacks expands, so does the impact of these setback ballot measures. And again, in this table, you can see that depending on the setback distance and depending on how many locations trigger that setback, the research shows that the reduction in new oil and gas production that can be caused as a result can be a reduction of up to 90%. So again, some pretty significant impacts that we're talking about here. In the table, you'll also see that we focus on a number of economic impacts, primarily 4 measures: reduced oil and gas production, job losses, economic losses, and lost tax revenue. And on the next slide, I want to give you kind of a very, very high level summary of what we found, all the trends across all of the different research that's already been done. And really what we found is that under setback ballot measures ranging between 2,000 to 2,500 feet, the impacts begin with job losses in the tens of thousands, economic losses in the billions of dollars, lost tax revenues in the hundreds of millions of dollars across state and local government, school districts, and other special districts. And what we also find from the research is that there is a significant escalation in these impacts over time. So the impacts are very significant in the short term, but they get more and more significant over time as one of the very important sectors of the Colorado economy is more and more constrained by the application of these setbacks. Now, just to be clear, these results are based on research into past setback ballot measures. So this year, there is one ballot measure that is effectively identical to the setback that was proposed in 2018 and defeated by voters. You probably remember that one. It was called Proposition 112. But there are 4 other ballot measures, setback ballot measures with different distances and different locations that would trigger setbacks of between 2,000 to 2,500 feet. And there's also a 6th ballot measure that avoids the setback issue and instead would dramatically increase the financial bonding requirements for newly drilled oil and gas wells. So we're closely monitoring those measures as they enter the signature gathering phase. And we hope to bring you updated research on those measures at a future date. But with all that said, the existing body of research on 2,000 foot and 2,500 foot setbacks, we believe, contains a lot of useful information today for policymakers and the public, at this stage of the debate. And what our new report aims to do is to summarize that information in a user-friendly way to help people decide for themselves, whether these setback ballot measures are a good idea or a bad idea. And at the same time, something else that we sort of explored in this report that we released this week is the way that these setback ballot measures, along with a lot of other things in public policy, have really been cast in a new light because of the steep and unexpected economic downturn that we're experiencing, and that Kate and Patty did such a good job explaining earlier on. But just remember, all of the research that was conducted into setback ballot measures in the past was conducted during a period in Colorado's history when we were experiencing, steady to very robust economic growth. So if those are the impacts that would be experienced in good times, there's a very pressing question, I think, about how would those impacts be felt in bad economic times like the ones we're experiencing now. Next slide, please. So I just wanted to leave you all with a kind of a closing question that we pose also in the report that we released this week. I guess a little bit of background that goes into it. During a recent webinar, you may remember we discussed some of the lessons learned from the last recession and how Colorado recovered from it. And we looked at the industries that helped lead our state out of the recession much faster than the rest of the country. And of course, the energy sector was one of those industries. So our report poses a new question about setback ballot measures, and that is, if public policy prevents one of our largest industries from ever recovering, how much deeper will a recession be, and how much longer will it take for the Colorado economy to recover and return to growth? Thank you, everyone. Again, I really encourage you to check out the full report on our website if you have time, and I'll hand it back to Kristen.
Thanks, Simon. And you're going to get off the hook easy today. No questions for you. So great final question for us to all ponder. It's my pleasure now to introduce somebody that we need to all give a lot of accolades to lately, Senator Bob Rankin, who is from the West Slope. He represents District 8. His lovely wife, Joyce, is also a public servant on the Colorado State Board of Education. Senator Rankin has the last few weeks been in the trenches. He's on the Joint Budget Committee, and we are thrilled today that he's taking time out of his busy schedule to give us an update on what the current JBC is dealing with as they look to gavel into session next week. So Senator Rankin, thank you, and I will turn it over to you.
Thank you, Kristen. I'll see if I can start the video. I know you're anxious to see what a tired old man working on the budget committee looks like early in the morning. I apologize for logging in late. A lot going on these days. So I don't have any slides. We're not there yet. So I'll try to give you a little bit of an overview of what the budget committee is doing, at least in process, and sort of where we are. I did want to, if I might, just comment on the last presentation, which I find extremely interesting, of course, since I represent a lot of the gas patch out west. And I was on a call with just a few days ago with the CEOs of local people who are running the companies out there. And I just want to make a point that, I think that what I argue is that Western Colorado is different, and we should advocate for those differences as we look at recovery. First of all, our counties, so far, none of our counties are active in putting regulation in place more severe than the state, which it must be more severe if, whatever that means, if they are their own regulatory environment. Secondly, it's gas, not oil, and there is some hope that gas prices will move upward in the next year. But the argument that those folks made that Colorado, and so, I read something recently that in terms of attracting capital, because of our regulatory environment, we're about 20th out of 20 in the area, the patches, the gas areas and oil areas that were ranked. So what their problem was attracting capital to drill their next well. I think we have one going at the moment in Western Colorado. So the ability to raise capital is based on all of those things we just heard. The investors are just not interested in when they compare other areas to Colorado. So, I saw that Kate was on your agenda, so you already know everything about forecasting. And, so the budget committee, going back to that, we started off in our March 16th forecast, and which is our formal 3-year forecast. And Kate and presented the Ledge Council, works for the legislature, and OSPB, the governor's office, present theirs, and we go forward. But at the time, we realized that things were changing rapidly, so we asked them to update their forecast on May 12th. And on May 12th, we realized that either forecast would require that we cut $3 billion out of about a $13 billion general fund forecast, 25%. So that task has actually never been done quite that much. I think 2008 was pretty bad. So we set about, we had already been working, our staff had developing options to reduce spending. And we proceeded then after that May update to start to make decisions. And that is the budget committee, 6 of us, 4 Democrats, 2 Republicans, drawn from both houses. So we set about voting on those reductions. So our task was to get enough of those that we could balance the budget in accordance with the Constitution. So where we are today, every day, our wonderful staff comes in and tells us where we are on the things that we've already voted on. And yesterday morning, we had $1 billion left to go. I mean, our task is to get all that done. Hopefully, we can make all our votes today and send our staff off to write up the quote long bill, present that to the legislature on the 26th, at which point, who knows what's going to happen. There are about, we call them orbital bills because they orbit the budget bill. This year, there will be a record number of those, about 50, because we have to change statute to align with all of these ideas we have for reducing the budget. So when we do that, all of those bills will have to go through a committee of reference. Then they go to the House floor, go to the Senate, and go through a committee of reference and get voted on in the Senate. Thank God in the Senate, we have a consent calendar, so that will go a little bit better. So the things that are affected, we tried to save school finance for last. In other words, take everything else we could do. But last night we voted to increase the deduction to, for example, personal services, salaries, people. In state government, we have to go to 5%. For our providers, those are folks that we hire to do Medicaid services, things like that. They're getting a reduction as well. The no increases across the board. We are deferring the para payments. We're taking the school grant program BEST and diverting almost all of that, a good chunk of it, to the general fund. The things that I've objected to, and we all have our favorites, but I voted against taking away the senior homestead exemption, so that has not been included. And I've been opposed to, we do something called sweeping, which is go out and find every dollar that's in a cash fund that hasn't been spent, and we sweep those to the general fund. So I vote against anything. For example, if you paid a fee when you got new tires, waste tire fee, I don't think you intended that to be spent on Medicaid, which is exactly what would happen if we sweep all those cash funds. So we have a list of cash funds, amounts to 10 million or so, that those cash funds were built up because people paid fees or penalties for a different purpose. So I voted against sweeping all of those. So there's still some of those things that are on the table, and the Democrats may run a parallel bill to do that, to, for example, 170 million in the senior property tax exemption. That will leave us with cuts to K-12. By the way, Higher education, of course, is not protected by the Constitution. So we are taking dramatic cuts to the higher education budget. However, the other real difficulty in all of this is estimating the impact of federal funding. And we had this $2.2 billion of the CARES Act that came along. 500 was allocated by federal government to large counties. That left $1.7 billion to the state. Some of that should go directly to counties, and the rest, in my view, should have been funneled through the appropriation process, although there are restrictions on that spending. Well, Governor Polis decided, and it's quite a surprise to me, to distribute all that money directly. I don't believe that was the intent of that law, but he did it because the legislature is not in session. So we are scrambling in the last few days of this process to find out the effects of that distribution. Our analysts are going through trying to match whatever it is the executive did to our budget items to see how much impact there is so that we can then reduce our spending or the state's general fund spending if possible. So we've been doing that in the last couple of days. Really complicated the whole process in my view. I put out a pretty strong press release reacting to that because we had been told by the governor that the legislature and the JBC would be in charge of spending. And we were expecting that. So that's a complication. But in the end, we are. So you look at higher education and it looks like we cut their funding by 58%. But in fact, that's been, we think that that's the replacement of federal dollars. So we're trying to rationalize the federal dollars. We're trying to get down to the last dollar today, turn that over to our staff, who are really burned out at this point, and get a bill put together. And then on the 26th, we start trying to, the six of us will each carry a number of those bills and try to get them through the legislature to get to a balanced budget. Don't really know what else is going to happen when the legislature comes back, how many other bills we will consider, how much else will be going on. Those decisions are yet to be made, as best I can tell. So that's sort of a rambling recollection of what's been going on. And I just can't thank our staff enough. We're working, the Joint Budget Committee has to be very bipartisan, and so we work together very closely to try to make good decisions. I think in the end, it'll be a good product under the circumstances. Nobody is happy. A couple of analogies. I said, okay, I'm fiscal conservative. You know, there are a lot of things I don't think the government ought to be doing in the first place. So you take all those and subtract them from the budget, and you get the first $200,000 or $300,000, and now you need $2 billion more in cuts. So that's about what it's like. I mean, we literally, we're throwing widows and orphans out on the street. So all that, with that great news, any questions or do we have time for any?
Well, thank you so much for joining us, Senator Rankin. I know that you've been so busy the last few weeks. We can't thank you enough for your public service and for being there to do this important work, and especially for addressing the CARES Act money and what's next. We do not have any questions at this point, but thank you again for joining us. As we conclude our program, oh, we have one question just came across. Given the potential cuts to K-12, does this increase the appetite to change the K-12 funding formula?
Boy, I wish. That's my favorite question. I believe that our school finance is the most screwed up system in the entire United States for funding schools. There's massive inequity in the taxation because the mill levy inside our formula ranges. Some people, one county, one district pays 2 mills, and like Pueblo pays 27. And then on top of that, local districts can pass mill levy overrides. And that depends on your asset value, right? You take your asset value, divide it by the number of pupils, and it tells you what you can get with local overrides. So we have created, local overrides are now $1.5 billion. And the so-called negative factor is 572. So we have created this massively inequitable system. On top of that, we've had this interim school finance committee for 3 years in a row. I argue the only thing they ever, excuse me, the only thing they ever accomplish is to give themselves another year of life. So we have this, the formula is not equitable, and particularly for rural schools and small districts. So I almost want to vote against the whole School Finance Act just because I don't think it does a good job for taxpayers or students. So is there appetite to change it? Yes, I'm arguing in the budget committee for at least a formula change. First of all, I'd like to reduce the cost of living factor, which creates great inequity. And the other thing I'd like to do is have a remote and rural school factor that weights those more. I don't know if we can get that done. It's just, there's just so much going on. But you know, if I get reelected, which of course we're all up for election, I have two, I'm going to be fighting to get some rationalization of that school finance situation, because I just don't believe it's constitutional, and I don't believe the legislature is meeting its moral obligations to give every student the equal opportunity. So thanks for the question.
And you know, that question was from our education fellow, Dr.
Yeah.
Honor, who just released a great report on our website on learning loss in the COVID slide. So I encourage you all to check it out. We have one last question, Senator Rankin, and then we are coming up against time. So I want to make sure that we wrap it up, be mindful of everybody's schedules. The last question is, wonder if you think the JBC might get run over in a super political year. And by that meaning, do you anticipate any sort of cuts coming from members outside the legislative, outside the current discussions? Are there some way? There are always some changes made during the long bill process.
Yeah, I do. And, you know, there's some of those things have already surfaced. I think that the School Finance Act itself will be run outside of JBC. Well, it always is. And so there'll be some, certainly some issues there. There are others, the senior homestead property exemption. I actually voted against it. That vetoes it as a JBC bill. So if that has to go away, and I think that there will be there will be a bill to do that. And there are other things like sweeping some of these cash funds that I mentioned that will run outside of the JBC. It will be an unusual year in that sense. It's clear that we need every cost reduction we can get, but there are just some things that go across the line, you know, that you just have to, the JBC should not be doing. If they're major policy issues, you know, that have been around for years, I don't think the JBC should just jump in and make some assumption that we can enact those things. I think they should get an airing in the legislature. And so that's why there will be some outside.
Great. Well, thank you so much to all of our speakers. It's this time in our program where we usually show our speakers a little token of gratitude and give them a CSPR coffee mug. While we can't do that in person, we'll make sure to get you all them. But Simon, Patty, Kate, and Senator Rankin, thank you for joining us. I have one last big announcement. We are celebrating our 10-year anniversary this year at Common Sense Policy Roundtable. And with that, our board of directors is going to be unveiling a new logo and a new look for our brand. And I want to share that all with you now. The big unveiling will be coming on June 1st, but we are going to be undergoing a name change, and we will be calling ourselves the Common Sense Institute. So look forward to sharing our new mission, vision, and brand look with you all, and look for something coming on that June 1st. We're very excited about it. Thank you again for joining us for this virtual Eggs in the Economy. Hopefully at our next quarterly meeting, we're able to meet in person.
Thank you.
Thanks, everybody. Thank you.
Thanks, Kristen. Thanks, everyone.